saying, well, in 2 years' time, we might possibly thinking about maybe raising rates. And at that scenario, suddenly the dollar explodes and the markets get a bit wobbly. And everyone thinks it's because rates are going up. Yeah, but that's not what the bond market's telling you. The bond markets are saying, well, if you do that, dear fellas, you're going to destroy the economy. So therefore, the bond market's saying, actually, we're going to start flattening the curve and we are going to see yields come off. So I want to show some charts just to talk through this narrative a bit further. So I'm going to try sharing the screen now. So here is the chart of the DXY. That's the dollar index. The dollar index had tried to make a new low but failed. And I've been following things like the DMARC indicators, and they were saying the dollar had bottomed when everybody was saying the dollar's about to break lower and it's going to be a catastrophe. I'm like, I'm not sure about this. The dollar's the key macro variable because everything is priced in dollars. So if the dollar goes down, if the dollar goes up, then commodities go down. It's the inverse because of this denominator, which is the US dollar. Don't confuse that with this denominator stuff I've been talking about, the Fed balance sheet. That's a different thing. That's about fiat currency. But just in straightforward terms, when the dollar goes up, commodities start coming down. So the dollar looks like it's forming this inverse head and shoulders. More dramatically, if you want to see it the other way around, here's the euro. It's a huge head and shoulders top. If the euro breaks this kind of 116, 117 level, chances are it goes to 110. What does that mean? That means basically the reflation trade's about to get unwound. A stronger dollar means weaker commodity prices. It's happening in lumber, it's happening in ags, it's not happening in oil. Copper, potentially it's happening. But usually if the dollar starts moving sharply, commodities come off and the inflation narrative changes. Also, 10-year bond yields, you saw they kind of spiked a while ago back in March, and they've been coming off since. Now we're starting to get to the key level, which is about 140 on the 10-year. If we break that trend line, then the likelihood is we start going back towards the lows. Now, I think I talked to Ed about this last week, is every single post-recession period since 1962, bond yields have had a sharp squeeze as everybody has tried to price in inflation. And they're always too early. And usually this is just the rebound effects. And then stimulus from whether it's the central bank cutting rates or QE or fiscal stimulus from the government tends to falter. And the central bank, in every circumstance, has come on and cut rates 2 more times at least after the recession finished. And bond yields fall. So I've been waiting for this setup, and it's looking that it's starting to happen. The other thing that most people don't realize is that the dollar tends to go up when bond yields fall, not what people think, which is when bond yields rise. The reason being is the dollar is a safe haven. And if things look like the world is slowing down, then we tend to see money flow into dollars. That increase in the price of the dollar, as I said, lowers inflation. So they work in a feedback loop that drives the dollar higher and drives rates lower. Very typical. See, what's actually going on is the forward-looking indicator, which is, and again, I showed this last week, which is China's credit impulse, which is a good driver of the Chinese business cycle, has been coming off sharply. Chinese economic data has turned negative. And the US business cycle and the world business cycle tends to follow suit soon after. So it's kind of saying, and that's typical again, after a recession, you get the initial sugar rush, and then everything calms down and growth slows back down again. That's usually when the central banks go, oh my God, or the government goes, oh my God, and they start stimulating more. So we've got this slowdown to come in the second half of the year that the markets are not expecting. The year-on-year comparisons for CPI as well will automatically mean CPI comes down from 5% to, let's say, 2.5%. So everything's going to feel like it's less inflationary, And we won't know what the true growth forecast is or where growth is going to lie. That's the story for next year. This year, it's going to be probably oh my God, we've got this wrong. The economy's not so strong. And the government will use that as an opportunity, as all the governments will, to ram through more fiscal. They're just waiting for the opportunity to do it. And that will probably mean more QE. So that is the key part of what's happening right now in markets. Let me get rid of this screen. I've got some more charts to show you later. And so I think the narrative has changed. We're in a transition phase where people think it's reflecting the fact that the Fed are going to raise rates in 2 years' time. That's nonsense. Even I can't remember, one of the Fed governors is on the tape just now saying the Fed always over-anticipates at this point in the cycle. The reality is, I think we've got a slowdown coming, and this reflation trade is going to be proven to be well too early. The commodity supercycle may be in play, but that's next year's story. I think this year's story, slow down, more stimulus. You're on mute, Ash.
Just to connect to the news cycle for people who aren't following it this closely. So, we saw in the middle of the week on Wednesday, the Fed was unexpectedly hawkish by market expectations, meaning they signaled rates would be rising faster and sooner than people believed, but out in 2023, if you look at the dot plot, if you believe that that is indicative of future policy action, which is always a question, Treasury prices declined, yields rose, particularly in the 5 to 7 year maturity range. The 10 was up about 10 basis points, break evens on inflation declined. So what's so interesting, Raoul, about your thesis is that this brings it more into a bigger picture framework to look at what is happening in the future.
So what's interesting, Ash, is yields went up for precisely one day and then collapsed to a new low.
Yeah.
So today and yesterday, yields plummeted. That is not normal behavior here. It's telling us something is different is going on than the prevailing narrative in markets. It tells you that the Fed are not going to raise rates. Or if they do, it's going to curtail inflation. But they're only talking about 2 years' time. Are they going to start tapering? Probably not. Well, they will start to try to think about tapering. And the rate of change of the Fed balance sheet is slowing down dramatically. But my guess is they'll have to pick it up in due course. And that affects all asset prices. So the stock market is now like, I don't like this change. I don't like this dollar moving fast because that's the big daddy. And if the big daddy's upset, it spooks everybody else. Volatility is contagious. So if the big daddy, which is the dollar, the denominator of everything, is like screaming high, the equity market's like, whoa, I don't know what this means. I mean, I already had a call with a friend of mine who runs a giant hedge fund. He's like, oh, we're having to bloody take down risk and hedge because this dollar thing is blowing up all our trades because everybody's in this reflation bet. That was the value versus growth bet as well. That was basically this point in the cycle, value outperforms. Now, if we go to a looser monetary policy environment again and slower growth, it means tech stocks start to outperform again. And we saw that yesterday and the day before. Things like ARK start really performing again as the equity market starts shifting its inflation narrative as well. So it's going to move equity markets. It's going to probably create volatility. If this carries on and those head and shoulders in the dollar break, the equity market's going to have a puke, a VAR shock. Then what we'll find is rates will come lower because it offsets the fact that what the equity market's doing. The dollar is lowering the rate of inflation, which brings bond yields down. The Fed start going, oh, well, sorry, we didn't mean about raising rates. What we actually meant was, we need to make sure everything's all right.
Right.
Commodity prices fall because of what's going on. That lowers the inflation narrative. And things like gold and Bitcoin, which really do well when the printing presses start up again properly, i.e. the rate of change starts increasing, they will start picking up then. Meanwhile, they get caught out in the crosshairs. Gold, for example, gets hit by a stronger dollar because it's priced in dollars, but it also benefits from weaker bond markets. So it's kind of somewhere in this kind of crosswinds. And Bitcoin's also the same. But as the narrative shifts, and remember, macro narratives take time. They're not instantaneous things because you need economic data to start coming in weaker. When that happens, we'll likely see gold and Bitcoin explode higher again, along with probably tech stocks, maybe after a sell-off first.
Yeah. Well, while macro narratives take time, Raoul, what you're discussing right now, you can see it on the tape. If you look at the 10-year yield, you can see it trading going into Wednesday at about 149 on a yield basis, 149 basis points, shoots up, as you said, about eight basis points on the news, and then it just rolls over 144. I mean, it's extraordinary to see that this is really reflected in the real-time data on U.S. Treasuries.
That's right. And so I will always say it, pay attention to the bond market. You know, the bond market was telling us something different. Then suddenly the dollar picked it up. And equity's always like, well, what's going on? Oh, shit, macro. The equity's always the last to figure out macro. So I think the macro outlook is changing and the market's wrongly positioned for it. But don't forget, we went into this with the biggest ever short position in the history of the dollar, and one of the biggest ever short positions in the history of the bond markets. That's the magnitude. I mean, everyone's record long copper. Everyone's record long all parts of this inflation trade. And they're now talking to their risk managers going, are we going to have to cut? Now, it's happened so quick that they haven't cut risks. But this goes on next week or the week after. You'll see the equity markets reflect this volatility as well. And I love these macro knock-on effects. It's where we make all our money trading macro, is understanding these kinds of linkages and when things change.